Ladies and gentlemen, dear all, thank you very much. I'm delighted to have the opportunity to moderate this panel on ESG financing, and I would like to start with the quote, making kind of a bridge, a link to the previous panel, a quote from SRK, which I thought was brilliant. Ability to attract capital is influenced by ESG credentials. So that directly connects the current theme. What are the finances looking and requiring from the projects to make them kind of bankable and financeable. Going into kind of terminology. So what are ESG credentials? They are centerpiece of sustainable finance. And what is sustainable finance? It's taking environmental, social, governance aspects into account in making investment decisions. Sustainable finance is critical to deliver the European Green Deal, which is making Europe climate neutral by 2050. It's a transition to climate neutral, climate resilient, resource efficient, and fair economy. We have an exceptional panel of finances, of stock exchanges, of advisors. And I would like to, the first presentation will be delivered by Robert Manse, who is the chairman and managing partner of M2 Capital Metal Mining Team, an advisory firm focused on metals and mining sector. The topic of the presentation is financing crisis times. Robert, the floor is yours. Thank you.
Okay. So thank you very much for having me today. My name is Robert Mant. I had a firm called M2 Capital Partners. We're headquartered out of London, out of Mayfair. We're actually 2 doors up from Annabelle's. So thank you. And next slide, please. Again, forward-looking statements. That's a beautiful Ferrari as far as I'm concerned. So contents, just a brief introduction on M2 Capital, the economic consequences of Russia and Ukraine war, and then outlook, and the outlook includes obviously a discussion on financing. Next slide, please. So M2 Capital is, we're really focused, we're an Anglo-Canadian private equity investment firm. We're focused on value creation. We're really focused on 5 sectors: metals, mining and materials, oil and gas, real estate, banking and insurance, and venture capital. And there really our focus is mine tech and clean tech startups. And just an example, we're involved with a company called Lightest out of Calgary. They're actually it's a startup. It's a mine tech startup. They can process lithium out of brine at 1/3 the global costs. The name is Lightest. You'll probably hear more about it in the next 18 months. Next slide, please. And again, we're focused on shareholder value creation, and that should actually say stakeholder value creation. We also we're very involved in charity, and we're also very much involved in the communities where we deal in. And so it says shareholder, they'll have to be updated. It should say stakeholders. On the focus in terms of the firm, we're really focused on 4 types of efficiencies. Managerial. So when we take over a company, we augment the management team as possible. We make sure the management incentives are aligned with the stakeholder and shareholder incentives. Operationally, we're bringing the top consultants to optimize the assets. An example of that would be we are the last 2 standing bidders for Alvance aluminum wheels in France. That's the largest aluminum wheels manufacturer, has capacity of 1.6 million wheels. Currently, it's operating at about 40% capacity. We went in front of the bankruptcy. It's in bankruptcy. We went in front of the Paris bankruptcy judges on the 25th of January, and we're still waiting for a decision. Technical, again, that's a great example. For AAW, we made an offer of buying it for €1 and investing up to 50 million euros, buying the best technology out there today. In terms of capital, we tend to optimize the capital base. We do rely heavily on leverage because that augments our returns. But I would say in a very risk return optimized and very strategically. Next slide, please. Next slide, please. And so this slide is really, I mean, it really lays out the background for the last 5 years. If you look at the far right, aluminum record highs, palladium record highs, thermal coal record highs, and then if you look at the bottom again, more cooking coal. Those are all majorly produced by Russia, and so this kind of gives you a little bit of insight on if you start looking at the sanctions and all the things that are being rearranged. This has been a windfall for the Russian government and Russian exporters, of course. Next slide, please. Here basically lays out as a percentage of global production. Palladium is number one, around 40%. Two largest producers of platinum and palladium are South Africa and Russia, and it's a 3-to-1 ratio. So if you look at Russia, it produces roughly 3 times palladium to platinum production. It's actually reversed in South Africa. It's 3-to-1 platinum to palladium. Very interesting, and has to do with geology. Diamonds, again, over 30%. Thermal coal, very important for electricity and heating, almost 20%, and platinum is still north of 10%. Nickel and aluminum. Steel, global steel, if you look at capacity over the last 5-10 years, it'll range between, actually I'll narrow it, 70 to 75%. And so that's where you've seen the largest sanctions because there's a lot of excess capacity globally. These sanctions are being driven by economics and politics as all things are in life. And again, copper and iron ore, and especially steel. Ukraine is a large producer. It doesn't import the iron ore, but to an extent, but it's a large producer. Next slide, please. This is a Wood Mackenzie, one of the best consultants out there for the metals and mining sector, and this is a quote: "The Russian-Ukraine war is reshaping geopolitics, threatening the global economy, and disrupting commodity markets." This is absolutely true, but it's a simplified analogy of the situation. We believe that for those who position themselves strategically, this is the greatest economic opportunity to rise for global financial and commodity markets since the end of the Great War. And keeping in mind, there were no 2 world wars. There's one Great World War, and there was an armistice for about 20-25 years. An armistice means there's no winner, no loser. It was one war. Next slide, please. Here, again, just really outlining and bringing home where Russian and Ukrainian production and trading and trade supply really stands out. And if you go from left to right, aluminum, 4 million plus of global production, copper, 5%, nickel, Norilsk Nickel, the greatest nickel company in the world, iron ore, steel, again, the Soviet Union was the greatest producer of steel before it broke up in 1991. Again, thermal coal, met coal, very important going into steel, and then cobalt again. You got Congo as the largest producer, about 2/3 of the market. So that even that 5%, that could be a swinger for production. As an example, a number of years ago, Glencore shut down one of its zinc mines, decreasing global supply by 3%. 3%. The price went through the roof. Next slide, please. There's a number of slides here. kind of go through them quickly, just so that we can focus on the Q&A. Again, geopolitics, business and politics, you can't have one without the other. And so the EU is looking at a coal embargo. Finished steel remains the only Russian commodity that's banned. Why? Because there's 30% capacity out there that can be brought online. So there's no great risk there. The sanction creep continues, focused on individuals and banks. So you've seen a lot of oligarchs being sanctioned. You've seen Sberbank and VTB, the two largest banks in Russia, also being sanctioned. Economics, the IMF has revised downward growth from 4.4 to 3.6 for 2022. 3.6 is still an outstanding number. What really is, and again, the emerging markets are faring better than the slowing growth in the G7 economies. Revisions include Russian and Ukraine economies shrinking by 8.5% and 35%. What isn't being stated there is that's true, but not for metals and mining. For metals and mining, these markets are on fire, and especially for oil and gas. This should be, and this is a great word for gold, for the gold market and for gold bulls. Inflation is set to linger. We're going to see, and the easiest way to see it is you look at food inflation, which I went shopping 2 days ago in Budapest. I'm I would calculate the food prices are up 30 to 50% since the end of last year. It's really unsustainable. It really, especially for people in the lowest quartile of the wealth curve, it's a catastrophe, and I don't see politicians addressing it. Next slide, please. And again, I'll go through these. There's a lot of information here. Again, coal is very important to EU. It's very important to the world. There's two kinds of coal. There's thermal coal, which is for energy, and metallurgical coal, which is for steel. Both are very important. I'm not going to go into the details. It's here on the slides. If we'll have these slides translated into Albanian and possibly Ukrainian and Russian, but it's kind of laid out there. Again, I'm not going to go. I could spend half an hour on this slide. Next slide, please. Again, if you look, aluminum, copper, nickel, the three most important of the five very important base metals, all Russia. It's all Russia, and to an extent, to a limited extent, Ukraine, but not really. Aluminum, copper, nickel. I mean, that's Russia. Next slide, please. Here, this becomes very, very important. As we saw with the semiconductor capacity limitations, we're seeing less and less cars. Depending on where you are in the world, used car prices have gone up by 20 to 50%. For PGMs, Russia is a major producer. As I mentioned earlier, for palladium, it's 40% of production. Even for platinum, it's 10% of production. Those are major numbers. If that supply was to be impacted, we would see a global slowdown in the economy. Prices are at record prices, and they'll remain so. Next slide, please. Okay, in terms of the outlook, we've looked at a number of scenarios, de-escalation scenarios, so where you see the war ending and a rolling back of sanctions. I'd say this one probably has the lowest probability, but it's very, very difficult to call. People that do this for a living, very, very difficult to call. The major point here is that you would see prices moderate downwards, but you're still going to see elevated prices. In terms of trade disruptions, I mean, that would be a catastrophe. You're seeing disruptions now, either with direct or self-sanctions, and no one's talked about this, but what if Russia were to retaliate? That you would see you would see palladium numbers, prices double or more. Global growth weaker, definitely is going to have an impact, and especially where Russia is a large producer. And again, platinum, palladium, aluminum, coal. Coal is very political. If you look at the prices now, record levels, and coal it's shipping it. First, you got to rail it. So getting it out of Russia, there's constraints on the rails, and then on the ships. And what very few people talk about is certain ship owners will not go into Russian ports now. And so that's also created a bottleneck. Next slide, please. Heavy sanctions scenario. My father actually saw this presentation. He said, "Stay away from the politics. It's just too much, both in terms of complications and everything else." Can the sanctions get worse? Absolutely. I think we've seen most of what's going to happen, but again, who knows? Again, direct sanctions or self-sanctioning, it's an isolation it's a direct isolation of the Russian market, and yet at the same time, Asia and Europe is leading that, and so is the U.S. But Asia isn't. I'll stop there on that. In terms of demand shocks, European and global growth turning sharply lower. You're still going to see elevated prices, and so basically the message here is whatever direction we move in, you're going to see elevated prices for a number of years, and that becomes very important. Next slide, please. And before I say those two words, or one word in Ukrainian and Russian, spasiba, I'll talk a little bit about the financing. And so we're looking at elevated prices for a number of years, unless you see a financial crisis. If you see a financial crisis, all bets are off. And then you wait for the miners to collapse. They'll usually go down between 70 and 90%, and then you buy on the collapse numbers. If you look at exploration miners, I'll take an example: Silver Bear out of Russia. It collapsed over 90%. It actually much more than that. It went from $1 down to about 5 cents, maybe touching even 2 cents, limited liquidity, and then peaked at 144 when the silver price peaked back in 213, 212. And so on the financing side, you have two kinds of financing. You have buyers and sellers. On the buyer side, basically, I'll simplify it. You've got four groups. You've got miners, you've got mining and milling, you've got smelters, you've got refineries, smelter refineries together. So that's your third one. And then you've got traders, and then you have the final financier, which is the consumer, actually. And so for minings, this has been a great opportunity. For smelters, refineries, a little bit different economics. They tend to do well when commodity prices are low, because there's too much supply in the market, and so they can purchase it at a lower price, and so their margins actually increase. So there, it depends. There's a number of variables there. For traders, it's again, depends on where you're based. Different results for different people. If you're a trader out of the U.S. and you're being financed by U.S. banks, it's been good. If you're a trader based in Switzerland, but you're a Russian trader or Russian owned, it's been more difficult. And for the consumer, these prices still haven't moved through the market. There's a time lag.
Thank you, Robert. I'm afraid I need to interrupt you here. This is a very insightful presentation. I have a few questions. I'm sure there will be coming more questions from the audience. But we need to move
Can I get 1 more minute, please?
I beg your pardon?
May I have 1 more minute?
Okay, 1 more minute.
So that means 45 seconds. And so the fourth point is the consumer. It's the consumer that actually finances all this. That's on the buyer side. On the seller side, I'll simplify this. You've got commercial banks, investment banks, and basically investment suppliers. So that could be hedge funds, whatever else. Commercial banks are going to do well. Again, I was going to go in more detail. I won't. They're going to do well. The guys that are going to do the best are the investment bankers. Most of these M&A deals are going to be done on shares, but they're going to get paid in cash. And finally, the hedge funds are also going to do well.
Yeah.
Thank you.
Thank you, Robert. So the next speaker is Axel Kalinowski from London Stock Exchange Group. Axel is, among other things, he's looking after metals and mining companies in Central and Eastern Europe, and we're looking forward to his presentation. Thank you.
Hello, good afternoon. Apologies, I wasn't able to speak for the last 3 days, so maybe you can hear it. I try to get through it. Yeah, no, it's a pleasure to be here. It's great to see sort of people in 3D, face-to-face again. I know we all had sort of this difficult period, so thanks to Arthur and the team for sort of making this happen. And yeah, look forward to sort of shaking hands and meeting sort of as many people as I can. Just very briefly, I'm from the London Stock Exchange. I'm responsible for our activities in Central Europe, Eastern Europe, and Southern Europe. And yeah, as many of you know, London is obviously an important market in the mining space. By a number of metrics, it's the largest market for mining companies globally, particularly in terms of sort of number of companies, in terms of market cap represented by those companies. In this few slides, I'll touch on sort of quick capital markets update and give you an idea what's going on in ESG funding space from a capital markets perspective, if it works. Here we go. So just very quickly on the London Stock Exchange itself. So the organization, the exchange is over 300 years old, so it's a very old institution. But obviously over those many years, it's transformed into what it is, a global financial infrastructure business, essentially. The London Stock Exchange is listed on the London Stock Exchange. So it's a public company. Anyone can sort of buy and sell shares. It's, by the way, very fast-growing, very innovation-driven business. So even though it's 300 years old, the share price has been going up very, very quickly. So in the 10 years that I've been at the exchange, I joined when the share price was £6. I think this morning was £75. So even though it's an old institution, it's a very fast-growing institution. I would say one of the big sort of themes which are relevant for today is also the merger we undertook recently with Refinitiv. Some of you may know it, but it's essentially a financial data company. It's sort of the like of Bloomberg. It used to be known as Thomson Reuters in the past. Now it's known as Refinitiv. So London Stock Exchange Refinitiv merged in what was a roughly $25 billion acquisition or merger for London Stock Exchange. So today we have around 2,000 companies listed on our markets, and those companies are basically from over 100 countries. So it's a very, very international market. And also on the data and analytics side, Refinitiv is very, very active in the ESG space. So they analyze 10,000 companies, not just London-listed companies, companies across the world, across markets, both public and private, and sort of look at into those companies to look at what they're doing on the ESG front. Why? Because there's demand from the investor side. So investors want to get more clarity what companies are doing. So I think that's the big relevant point also for all of us here today, is there a substantial sort of push from the buy side to get more transparency, more clarity in terms of what companies are doing and where they are on their journey. And we're trying to support that. Okay. quick update on sort of what's been happening 2022. Obviously, we have a war and a crisis in Europe, so that has impacted capital markets. But nonetheless, as you can see, there is still a fair amount of activity. So this is the European landscape in terms of when you look at what's happening on capital markets. You can see London on the very left. There's still a lot of transaction taking place. And the number one reason is London is a global market, so you see activities from all corners of the world. More specifically on mining, why is London sort of relevant? 4 of the top 10 sort of largest companies in the world are listed on the London Stock Exchange. And also when you look at sort of the point that I alluded to at the beginning, 17% of all sort of mining companies that are public are listed on the London market, which makes it the largest market globally, followed by the Australian Stock Exchange, which represents 15% in the global sort of landscape. The sector itself is, as I mentioned, very well represented. So here you have a breakdown on the various sort of different type of mining businesses that are listed. So it's 179 companies that are currently listed. And in terms of the investors who invest in those companies, 72% are US/UK based investors. Sustainability and sort of the theme of the conversation is very important. So here, just a little table, and we can make this presentation available afterwards. So this is information you don't have to take any notes or anything, that you can access later on. But here, just a list of companies that have committed themselves to sort of sustainability and sustainable mining. So First Tin, for instance, it's a small company sort of that is has a tin project, a big tin project in Germany, is actually went public in April this year, raised around 20 million pounds, and it is very, very focused on sustainability. So basically, they try to be best in class on everything, sort of zero waste, zero carbon emissions. So, for instance, the power that they utilize, they generate, they obtain from sort of hydropower generation plants. Very transparent on sort of everything that's related to ESG. So they're trying to push the boundaries and clearly position themselves in terms of at the very forefront of the ESG agenda. Yeah, so there's more information publicly. Now, London Stock Exchange itself, for us, ESG and sort of anything around green finance is one of the big building blocks, I would say. So London has very clearly positioned itself to be the go-to venue of anything around ESG and sort of green finance. So we've won now for a number of years, I think 3 years in a row now, sort of the Exchange of the Year award. We have a number of sort of different instruments, whether it's ESG indices, whether it's ESG, i.e. sustainability bonds, green bonds, whether it's ESG or ETFs to make it easier for investors to actually track those kind of companies, whether it's funds who invest in sort of projects, or where it is companies that are leading from the front. So here we have over 100 sort of green, we call them green economy companies. They're not just renewable energy companies, they can be very traditional businesses. So for instance, one of my clients, an Irish house builder, you would not associate a house developer, sort of real estate developing business to be a green economy company. But basically what they've committed themselves to is to build homes that are very energy efficient, which is why they were awarded the green economy mark. Now, why is this all important? Why are we even talking about it? And the reason is that investors, so there's a huge growth in terms of even traditional investors. So imagine a traditional pension fund, no longer thinking just about, what's the return, what's the financial return that I'm going to make and generate when I make an investment, but actually what impact is the money making. So there's a huge push on the asset management sort of industry to adopt these kind of principles. And here you can see some of the growth in terms of assets under management. So it's a very fast-growing space, and more and more sort of asset management firms are signing up to principles which basically guide from now on we invest based on ESG prioritized principles. So that's the reason why all of us have to take this very seriously, because even formerly traditional investors are putting on the hat and using that lens to think whether to invest or not. Same thing, so that was on the equity side. Same thing is happening on the debt capital market side. So here you can see the growth of sustainability in green bonds. So you can see, for instance, that year on year, green bonds have grown 42% between 2021 and 2022 in terms of issuance. And Europe is one of the leading markets in the sort of sustainability and green bond space. And interestingly, also, why is money continuing to flow into this sector? So you can see here in blue, those are our green economy companies. Those are companies that are adopting ESG principles. You can actually see that they are outperforming quite significantly more traditional businesses. So investors who are investing in those businesses have actually seen greater financial return, which is gonna continue to drive. And the performance has been quite significant. So when you look at it over the last 5 years, it's been 115%, just from 2020 to 2021. So just last year, it was 26% performance. So that's quite substantial. And equally, supranational entities like IFC or like the Inter-American Development Bank are raising money to deploy into those kind of ESG conscious transition projects. So IDB, for instance, raised a $1 billion bond on our markets to devote to sustainability issues. And one thing I would also put forward, and we haven't seen much yet in the mining space, but we've seen a fair amount from other more traditional sectors like oil and gas and energy infrastructure, transition bonds. So transition bonds are bonds that basically are raised to enable the transition towards lower carbon transmissions. So here we have an example of a UK gas transmission company, which basically raised, how much did they raise? 2020 they raised 500 million, and 2021 625 million euro to devote towards upgrading their technology and their infrastructure to make them lower, more energy efficient and lower carbon emissions. Efficient. So yeah, those very quickly touching on those themes, but happy to cover more.
Thank you, Axel. A lot of data to digest and a lot of opportunities. I think we are, as a region, there is at least one example of a company which has raised funding on the stock exchange over the last 2 years. That's Eurasian metals, and I think that's an important example to follow. Thanks a lot. And the next speaker is James Cox, who will give an EBRD perspective on ESG. EBRD, without publicizing it, but has been involved in ESG financing since inception for 30 years, since the ESG environmental social assessment is enshrined in the agreement established in the bank. So over to you, James. Looking forward to your presentation. Thank you.
Thank you very much, Artyom, and thank you for that kind introduction. Good afternoon, everybody. I think it is afternoon in Tirana right now.
It is, yes.
Okay, good. Indeed, and I think just to echo Axel's comments, there's a lot of attention on ESG and ESG investing at the moment, and has been for quite a few years. And this is moving into the mining sector. And so what I'd like to do is provide some insights, at least from an EBRD perspective, of what ESG means for mining projects, both from the expectation when it comes to risk management, but also positive impacts and getting a project off the ground. but also provide some thoughts on what junior miners and exploration companies should be thinking about when it comes to ESG, when they're thinking about accessing finance and designing projects. Before I do that, I think many people know who the EBRD is, but for those who don't, essentially we're an international financial institution. We were established in the early 90s following the collapse of the Soviet Union. We have a very clear mandate, and that's to develop open and sustainable market economies in the countries that we invest in. We are owned by a large number of countries, many of which are in Europe, but we're also sort of owned by the European Union and also the European Investment Bank. And at last count, and I stand to be corrected here by Artyom, we invest in 39 different countries across Eastern, Central Europe, Central Asia, and also the North Africa region. As an investor and a lender, we have a number of core values, and I think critical to this discussion is our commitment on environmental and social sustainability. Indeed, we have our own standards that we apply to every single project, and I'd like to elaborate about how we use these, particularly in mining, and with all the attention that ESG is getting at the moment. Just one more slide on EBRD, if that's okay. We do provide different forms of finance, from loans and clear debt, project finance, to equity investments. We also provide some guarantees, and we have a few sort of criteria as to where we invest. And we cover multiple sectors, including mining, from sort of an early stage exploration to project development, to investing in existing mines and expanding mines and things like that. Okay, back to the ESG side of things. Now, I think many of us are familiar with the different frameworks out there for managing risk. You have the classic ones like IFC's performance standards and guidelines. EBRD, we have a set of performance requirements, a slightly different name, but broadly similar to the IFC. And these were there to sort of manage risks, to de-risk projects, and they apply throughout a project life cycle, from doing environmental and social impact assessments to setting up a management system to manage these issues and to monitoring. And in many ways, this risk management framework was there to acquire finance, but also to get a social license to operate, to address risks and to respond to what stakeholders are looking for. Now, more recently, there's a lot of attention on the Paris Agreement and on climate risk and what this means for projects and the use of carbon intensity and greenhouse gas emissions, but also reporting standards like TCFD, where companies are being pushed to report on how climate risk could affect their operations. Now, historically, there's been a lot of interest from lenders, governments and authorities when it comes to permitting, communities and NGOs, but this is changing a bit. You're starting to get investors who are looking at these issues as well. They're looking to see what a company puts out in the public domain to understand how they're managing ES and G issues. And in a similar vein, employees of companies are also taking note and wanting to work for companies that take this topic very seriously. And of course, there's a lot of ESG reporting out there to different standards, GRI, SASB, and the EU is developing its own standards for the disclosure of non-financial information, like with respect to ESG. But what does this really mean in practice? What are lenders, what are investors looking for? When it comes to risk management, of course, we want alignment with recognized standards, whether it be the performance standards or responsible gold mining principles or the PRI. And we want these to be considered very early in a project, at the very early stage from the pre-feasibility study. And we're looking to see how ESG, or particularly environmental and social issues, have been integrated into the project design. We see a lot of boilerplate designs out there without consideration of these issues. And as a lender, we want to see how these topics are really influencing how a mine is designed and operated. We talked about social license. This is a phrase that's been used for a long time. But for us, this starts really, really early on with earlier and continuous engagement with stakeholders, not just communities, but also regional stakeholders and governments. And it's not a once-off, it's a continuous process. We're obviously looking to see how ESG is embedded into company policies and strategies. But when it comes to technical matters, we're looking at a reduced mine footprint? Does it really have to be as big as initially proposed? Can it be optimized? Could you, say, commingle waste rock and tailings into smaller facilities? Things like that. Water is a hot topic at the moment. And so concepts like reduced water demand, a high level of recycling and reuse, and zero discharge are becoming standards on many, many projects. Now, of course, there could be technical limitations or situational limitations to this, but this tends to be the first step before looking at other options. And similarly to water, the topic of energy efficiency, greenhouse gas intensity, and a move away from fossil fuels is becoming more and more of a topic. Of course, things like a life of a project, the life of mine, dictates how this is integrated into a project. It's very hard to get away from diesel vehicles and diesel plant, but it is something that for mining companies to think about, particularly when you have a mine horizon of 10, 20, 30, 40 years. There's been a lot of attention about tailings management with the recent failings, or not so recent failings of various tailings facilities. So at least from an EBRD perspective, we're looking at, is this the safest design possible? Is it away from receptors, including both human and natural receptors? If dry stack is selected, why not? Because we're looking for as stable a structure as we can. And then biodiversity. Our philosophy is to support projects and to sort of influence projects to think about closure from day one. How would they build this mine so it could be closed easily? And so we're looking at things like progressive reinstatement, robust closure plans at a very, very early stage, not just some high-level points, and then looking to see how a project can give back to biodiversity. Because of course, mines can be reinstated, but they'll never be reinstated to the same state that they were in before. And so more often than not, with the projects we support, mining companies are having to go beyond their physical boundaries to look at potential offsite offsets on biodiversity matters. But this also helps with their social license to operate and to be seen as a responsible mining company. Earlier, I mentioned things like Paris alignment and climate risk. Now, Paris alignment obviously applies at a government level, and governments make commitments in this regard. But a lender like EBRD and others are having to think how their investments align with the objectives of the Paris Agreement. So when it comes to mining, we're looking at things like the intensity of the process, the source of energy. Is it grid energy? Is it an energy source on site? How energy intensive is it? And would a project be locked into that for many, many decades? There's a clear role for renewable energy as well, both buying renewable energy from the grid, but also developing renewable energy on site to supplement or power your mine in totality. A lot of this really depends on the life of your mine. Again, if your life of mine is only 5 years, there's only so much you can do. But if it's a longer term mine, things like this really have to be thought about, particularly with the targets that many companies and governments are setting into place with regard to the Paris Agreement. And if you have an existing mine, an existing asset that you're looking to expand or to improve, the topic that many people are looking at is decarbonization plans and also possible pathways to low carbon. In a similar vein, there's also climate risk. And I think for many companies, this has been on the radar for a long time. Like, how would climate change risk affect their business? Will it affect water supply? Would it actually result in too much water, high precipitation events, drought, things like that? And also a transition risk. If there was a shadow carbon price being applied or a pressure from government to lock up certain sources of energy, what would be the effect on the mining asset and the company itself? So those are with regard to risk management, which is the basics, and EBRD and many others have been doing this for a long period of time, decades. It's nothing new, of course it evolves. But there's an increased attention on what the positive impact is of projects. And in mining, it's not just jobs. We see a lot of sort of proposals that we're going to create some jobs, we will do some community investment, etc. That is the bare minimum. it needs to really go beyond that. And we see three areas. One is people, of course, and primarily your communities and sharing benefits. And this goes beyond just basic CSR activities. And also sort of benefiting your employees, which is relatively easy, but building up contractor bases and supply chains and sort of doing good beyond just your mine footprint. And there's also a lot of interest on positive impacts to nature. Are you enhancing biodiversity? Are you enhancing the ecosystem in which your mine is being developed and the services that that ecosystem provides? The risk management tools and stance can go a long way to addressing that risk, but activities need to be done to try and enhance those conditions and enhance those services that can be drawn from the environment. And again, climate risk. We of course, there's going to be a lot of mining in the future to support a green economy, things like lithium, rare earth metals, et cetera. And so mining can support that journey to a green economy. But to do so should also not cause harm to the environment, not increase potential locally experienced physical climate change risks, et cetera. So there's a lot in this sector. It's sometimes pretty complicated, but it is becoming more and more of an area of interest for lenders and investors. And maybe just to close out, I'd like to share some thoughts on what we as an investor are looking for when we engage with junior mining companies, with exploration companies, who may be at a very early stage in the project life cycle. When you think about the points I've raised in the previous slides, it sounds like a huge amount of information, a huge amount of things to do, but it's all a process. You have to start somewhere. And when we look at these projects, we really want to work with a company to help them put in place the right things at the right time and work with them over time so that they can create this sort of ESG structure within their business. And we do this from early exploration all the way to mining development. And what we're looking for really is a commitment from the company that we're working with that they are serious about ESG matters, they are serious about developing this over time, and that they are considering this very early in their process and engaging people to help them do this. We're not saying you have to have a full-blown ESG team on day one. There are many third parties out there that can support a very early stage mining project to really introduce ESG factors. I flagged this before about social license and sort of engagement with the communities. This needs to start really, really early on. Sort of when you're looking at exploration, people want to know what you're doing in the area, what the long-term plans are. And at the same time, they're looking to see how you perform as a mining company. So managing your impacts from exploration well is a really good start to you being seen as a responsible future miner and to getting that social license from communities. I would also add that think carefully about sort of CSR or community investments. Think carefully about this and particularly about promises made. We do need to manage expectations. I think the risk is there that a lot of commitments are made very early on, which may be quite hard to deliver. And there may be the wrong commitments or the wrong investments. And also in some jurisdictions, a mining company should not be there to replace a government or a government authority. So it's a fine balance. And the way we look at this is that to do this well, to share those benefits, to make the right investments, is to really understand the social environment. And this is just as important as understanding nature, the technical issues, understanding the area that which you're in, the communities, the stakeholders, what their needs are, what their demands are. And with this information, you can design a better sort of local investment program. And last but not least, particularly for investors, people investing in the stock markets, is access to information. So being transparent, disclosing information, disclosing what your plans are, and doing that on your website or in other forms. And that goes beyond just having a short sustainability page. It's really disclosing key commitments and key information as to what you as a company are doing. With that, I'll wrap up. Artyom, I hope I was within time, but happy to respond to any questions now or later.
Thank you, James. We're on time. Thanks a lot. A lot of insights. I'm sure there will be questions afterwards. So next speaker is Duško Krasmanovic. He will be delivering a presentation on behalf of UK Export Finance, where he's the chief representative for the West Balkans. Welcome. It's over there.
Remote is there.
Thanks a lot, Artyom. Good to be here today with you. Happy to see many of you here. I know that there are a lot of... Is that too loud? No? Because it sounds here, it's very loud. Happy to see many UK companies here. I met many of you last night at the reception, and I was actually impressed by the turnout from the UK. So what I'm going to talk about, it's relevant for you, exporters of UK services and goods overseas, but also for you who are potential buyers of these services. Because UK Export Finance can actually help you close the financial structure to purchase goods and services from the UK under favorable terms in case you cannot access financing the other ways. Okay. So what is UK Export Finance? It's the world's oldest ECA, export credit agency. I'm sure many of you have heard what export credit agencies do. They help companies from their countries export by providing different sorts of supports, both to the buyers and to them in their home countries. So what UK Export Finance is doing, we have various tools to stimulate and facilitate exports from the UK by working with the companies in the UK and with the buyers overseas. Here you can see what we basically do. We do provide export insurance policies. So if you want to implement a project overseas, build a factory, build a mine, invest in infrastructure, we can provide different sort of insurances to insure an investment overseas against political risk and other risks. We provide buyer finance, which I'm going to talk mostly about, and we provide working capital products. Working capital products is mostly relevant, I think, for manufacturing companies in the UK. Imagine you got an order from an overseas buyer to produce a large chunk of mining equipment, and you need 10 million to produce it, 20 million sometimes, so we can help you access working capital to deliver that good to your buyer. I'm going mostly now to focus on buyer finance, how it works, where it can be useful, as you see. And if you're interested, you know, many of you who are based in the UK, you might be asked, especially I think if you're delivering goods, to provide different sorts of guarantees to buyers. We can help you with that. But this is mostly now going to be focused on buyers. So who are the buyers or the sponsors? These can be, you know, investors in mines who are procuring your services. It can be governments, even sometimes different sorts of buyers who are willing to work with the UK companies directly or with the UK companies as part of a larger consortium. So for us, it takes not approximately, but only 20% of UK content to engage in financing and to provide part or full financing for the projects that involve exports from the UK. To do so, we have these three main instruments: buyer credit facility, standard buyer loan guarantee, and direct lending. So forget about direct lending. It's mostly for sovereigns. So if a government wants to invest in sustainable energy projects, then the UK Treasury can provide direct loan to the government of a country on a fixed interest rate. What I think is mostly interesting for you here are these two tools: buyer credit facility and standard buyer loan guarantee. How it works. And please also, I know that many companies here do business also across the globe. This all applies to any of the situation around the world. We can do financial support pretty much everywhere in the world, and in many also foreign currencies. So buyer credit facility, it's a facility where we partner with a bank, usually a big international bank, provide a guarantee on the loan they're giving to the buyer of your services up to 85%, to lower the interest rate for borrowing, to make banks more secure to lend money, especially in the long run, and to make eventually your equipment or services get sold in different markets. So we'll always do things with the partner banks, providing them a guarantee and ensuring they're willing to provide financing. As you see, these are just a couple of key features for the UK Export Finance to engage: 20% minimal UK content, We provide unconditional guarantee, financing up to 85% of the cost of the entire loan. We have 2 billion of direct lending facility for clean road projects. This is mostly government-to-government lending. We are able to finance in many different currencies. We work with credit-worked local banks, but we also work with big international banks. And yeah, that's pretty much, I think, basics of how UKEF can engage. There always needs to be UK exporter, essentially. This is a clean road direct lending facility I mentioned. We can do up to 2 billion for sustainable projects on direct lending directly from the UK Treasury, fixed interest rate. This is, I think, relevant for big investors, especially governments who are willing to invest in sustainable energy projects. These are some of the areas we finance projects in: clean transportation, green buildings, energy efficiency, according and in line with the Sustainable Development Goals of the UN. And now a bit more about ENS, because that's the main topic of this panel. So to put things very simply, how UKEF approaches financing of projects that involve ENS component. UKEF was this year awarded as the best world sustainable ECA. What does it mean? It means that last year we have not underwritten even one deal which was against the UK fossil fuel policy. So all deals were sustainable. There were no emission-related deals, and we are trying to lead the world in this respect. What does it mean in practical terms for you? It means that every project, mining especially, will have to go through a thorough due diligence, ENS due diligence, to qualify for our financing. How does it work in practice? It's very, I think, standard approach. It's not very much different than EBRD, what I just said. But essentially, we will be doing a screening of the project together with the banks interested to finance it, or with investors, to determine the potential impact on ENS of a specific project. And then, in line with the Equator Principles, we'll categorize projects in category A, B, and C. If it's a category A project, it means it has significant potential impact on environmental and social and human rights components. So we'll be very, very diligent there, ask additional independent ENS consultants to check on the project. And we will do it as long as we can be sure the project will be compliant with the local and international ENS standards. If it's not compliant, we will unfortunately not be able to support it, because we really take it seriously in terms of accountability to the UK taxpayers and integrity towards our stakeholders. And we do it because we believe that through our financing, which is also available for mining, we can reshape global value and supply chains. That's why we do it, and I believe that very, very few exceptions are going to be made in future also by other ECAs. So always think, and we yesterday spoke at the reception about mining and how mining approaches, especially, social component. My feeling was that mining companies and mining consultants internally, whenever they approach this and assess the potential risks, they do it, everybody does it by the book and everybody does it by the rules. But I think even more than that, in the future, you will have to pay attention, especially to the social impacts, stakeholder management, community management, because if all this is not set right, it will block the project and block the financing. And in many financing opportunities where ECAs will be involved, you will have this bottleneck that ECAs will not be able to provide support. So I think I really urge you to think about it very thoroughly whenever you have a project, to make sure it's as sustainable as possible and the risks mitigation plans to deal with the risks are as good as possible. If the things are well, we will engage in the financing, and in post-management of the deal, especially if the financing is 8, 10 years long, 12 years, we will occasionally do, depending on the categorization of the project, either independent assessments of ENS mitigation plans and implementation, or we will do site visits, or just ask clients to do self-reporting on this. But yes, this will be definitely one of the priorities for us. UKEF has this stand that we have a global appetite of 50 billion for financing, out of which we have spent or committed basically through guarantees 37 billions. So for us, risking this huge portfolio and risking our reputation in front of stakeholders and taxpayers, we won't do it because of one project anywhere, especially, it doesn't matter if it's mining or something else. So unfortunately, we might look as a strict organization, but I think we are doing the right thing by really taking care of our reputation in long term, and also by making sure that everybody who works with us has limited risks when it comes to reputation through an ENS lenses. Just a couple of case studies, very briefly. I was trying, UCAF does dozens of deals a year across the globe, many of them in infrastructure, mostly energy, small deals when companies purchase equipment. So I have found 2 deals we have done in mining. It was so-called standard buy and loan guarantees, small deals as we call them, up to 30 million euros. Your client wants to buy equipment or services or joint services and equipment from the UK, up to 30 million euros. We can help them work with a local bank, their partner bank or some other bank, to provide financing for that. So we did this in Tunisia, as you see, and UK companies won the deal because actually our offer for financing was better than the competitor's offer. So sometimes, try to make yourself competitive by partnering with us, because we might be just cheaper for you and your clients and actually make your offer more competitive against other offers. So that will be one of the cases, as you see, from Tunisia, and another one from Mongolia, which also included the supply of the equipment. But, all these deals, even these small deals, will have to go through a certain ENS filtering to go through. That's it. Thanks a lot, and I'm happy to take your questions here and also later during the conference. Thank you.
Thank you, Duško. Last but not least, we have Luca De Lorenzo, who is heading the sustainability team of the Nordic Investment Bank. And the important point to highlight is that Nordic countries, Norway, Sweden, Finland, they're all mining nations for centuries, and they are leaders, global leaders in setting standards in mining, sustainability of mining projects. So over to you, Luca.
Thank you, Artyom, and good afternoon, everyone. I'll try to be brief in terms of allowing some questions also to the whole panel, and also because some of the topics maybe have already been touched upon. But I'll try to anyways describe a little bit what we do and how we look at ESG and the mining sector from the Nordic Investment Bank perspective, and in general from the Nordic and Baltic countries. Let me share my screen. Can you see the slides, Artyom?
Yes.
Super. So a few words on Nordic Investment Bank. We are basically the international financial institution of the Nordic and Baltic countries. So we are effectively a bank, and we operate on a commercial basis. We fund ourselves in capital markets. We are AAA rated, and we provide long-term loans on pretty much commercial pricing. But of course, we are a slightly different bank in the sense that we are publicly owned, like you've heard from James, EBRD, similar setup. And our owners, we have a smaller members. We are the 8 countries, which are 5 Nordic countries and 3 Baltic countries owning the bank. We are not such a large institution. We are about 220 employees based all in Helsinki and operating primarily in our member region, so across the Nordic Baltics. We do also what we call non-member country lending, so across the globe, effectively, primarily in Europe. But that's only 5% really of our lending. We have a balance sheet of about 40 billion euros, and we do lending of about 3 to 4 billion euros per year. As I said, we fund ourselves on capital markets. We have a green bond program which you heard from Axel before, type of sustainable finance products that you can find on exchanges and so on. We've been doing green bonds since 2012, issuing green bonds and issued around 7-8 billion euros since. So quite experienced with that type of product as well. Where the most important thing is, of course, selecting the right projects going into the sustainable finance product, and then be very clear and specific and transparent on the reporting of the impact. But as Artyom was mentioning, now narrowing it down to the mining sector in specific, and why the interest in Nordic Investment Bank. We operate across many sectors, but we definitely cover the what we call the mining cluster. That's because it's very relevant to our economies in our member countries. Long history of mining, maybe not always the largest mines, although we have a pretty big one in iron ore up in northern Sweden. But also, interestingly enough, is because the Nordic countries have kind of the full value chain presented. So we have mines of very different metals, actually, but we also have mining equipment manufacturers, Sandvik, Epiroc, Atlas Copco, and then there are a lot of industries actually using locally the metal and the metals that are being produced. So we have a full value chain, and therefore we call that a cluster. And I think this concept, maybe adding on to what has already been presented for the panels, from the other panelists, is quite interesting and relevant for us, both from a risk perspective, because of course the risk is carried across the cluster for us as a bank, but also in relation to ESG and sustainability. You're not going to be able to operate, a sustainable mine and look at all the elements that James was mentioning without having a close collaboration and relationship with the mining equipment or the energy that you might need to run your mine. So we see this, cluster and value chain kind of concept and approach as very, very relevant when looking at ESG and sustainability for the sector. Few examples of how what type of projects we've been financing, and again, across the value chain. You see, we have Norway Boliden, Sweden and Finland Boliden Mineral. So looking both at actual mines and then smelters potentially in there, but also quite a lot of work with Atlas Copco, Metso, Epiroc. So mining related equipment manufacturers and R&D. So there is a lot of electrification and automation going on in that part, in that sector. And then lately also looking at something that has been mentioned already. So we are financing also Northvolt ET in Sweden. So that's the gigafactory being proposed and being built currently in Sweden, which is potentially one of the big users of some of the metals in the region and actually also globally. So again, looking at the full value chain. On this slide, maybe I'll try to go a little bit fast because I think James, actually from EBRD, you presented very, very nicely how us banks and financiers would look at this sector and what are the key elements we would look at when engaging in potentially financing a project. And you see, I think, very similar words: biodiversity, recycling, reworking, land use, water, very important, restoration, reclamation, and then all of the social aspects, so working condition, human labor rights, impact on local communities. Now, in our region, typically working conditions, labor rights are quite well covered by legislation and by permittings and all of that. Funnily enough, still local community and impacts, which can be also very positive, are very relevant in the northern parts of the Nordics. There are reindeer communities and herds that get impacted by mining activities in many areas. So there is a very close engagement and stakeholder dialogue that needs to happen. Just as an example, that even in our regions, this can be very, very relevant elements. But again, as James and described, and also Dusko just now, basically we would have our own processes, our own policies, our own standards that are very much aligned with what we heard before, where we would cover these various elements that are relevant in the mining sector. Maybe one thing to add to what has been presented so far is the opportunity and the positive impact side of things. So more and more, if I look back 5, 7 years ago when we were doing mining projects, to be honest, they were usually looked at very positively or potentially positively from an economic and productivity and local economy kind of development perspective from the bank. But from an environmental or sustainability perspective, they were always looked at relatively negatively. Now that I think has changed a little bit, and thanks also through the ESG lens, but also on the big push that we have to do on the transition of our economies to fight climate change, and the realization that this transition does require a lot of the metals that the mining sector provides. And therefore, suddenly the mining sector is seen as a contributor to this transition, a positive contributor. And here you see on the slides, basically, it's actually an EU study where you map the various metals and their end use, typically in the markets by volume, and also a supply risk element associated with that. And we look also at this as a bank, as a publicly owned bank, and basically we consider not only how you operate your mines, and so the ESG elements of the mining operations, but also what is the contribution effectively of the metals that are being mined, eventually to the transition. And that, of course, can be accounted for positively from an ESG perspective. I think this transition narrative, and Axel also mentioned transition bonds, sustainability products, again, financial products that one could tap into. But this transition narrative, together with the new kind of reality of geopolitics and supply chains being disrupted, really has put a different lens from an ESG perspective to the whole mining sector. So effectively, as long, at least in Europe, in our region, for sure. So as long as you run operations, as James described, with your right ESG credentials, and you're doing something that is contributing to the transition and is actually enhancing potentially independence and resilience of supply chains, suddenly all of this becomes almost ESG positive rather than negative impact. And I think this is something that has come up more and more over the last 3-4 years that we have seen. And so as long as you are careful and follow the right standards and look at the right material ESG issues, and I think there is, from a financier perspective, I think financing is not going to be an issue. With that, I think I'll stop, Artyom, so that we get some questions to the panel.
Thank you, Luca. While waiting for questions to arrive, I have actually a question to you, but I think your presentation nicely wraps up the whole kind of theme, especially because this Nordic region with the sustainability and the cluster of industries from mining to processing and to through the whole value chain, it's a nice example, blueprint for Western Balkans, for that matter, to how the sector could and should develop. And I think it will help the projects that NIB finances in the mining space. That could be case studies to follow. So a lot to learn from your experience, from experience of Nordic countries. And the question I have is, your focus is, 95% is on your core region, but the 5% is for elsewhere globally, and Europe in particular. And this is the question: what are the eligibility criteria for the projects in the Western Balkans to be eligible for you to finance?
Yeah, thanks. To be honest, now I didn't describe the whole process, but basically, when we do non-member country, maybe the most relevant set of criteria that is before we can engage is it needs some sort of Nordic content, Nordic Baltic content, sorry, from our member states. So that could be an equipment, investor. We can see some other elements, but as long as we have a Nordic content, we are able to engage. And then I think we would run it through the sustainability and ESG criteria that now I didn't have the time to go through in detail, but you've seen the slide. And if you heard James, they're very much aligned with EBRD as well. Sometimes we work together actually on financing projects. So as long as we have that, and then we of course do as a bank credit analysis and all of the things that a bank would do on top of that, of course, and look at the business case and the financials, then we are happy to engage. Final mentioning, we usually only finance up to 50% of a project, which is typical approach by IFI.
It's actually more aggressive than EBRD. EBRD will finance only 35%, but it's potentially could be kind of a nice club deal for a project for UK export finance, for Nordic investment bank, and for EBRD. A question, thank you, Luca. The question I'd like to ask James, maybe since EBRD is very present, engaged in the region, maybe based on the criteria which you described, you can give an example of a project which the bank was involved recently and which can be used as a case study, as a blueprint for other companies to follow, both either on debt or equity side. Thank you.
Okay. Look, we've done a lot of projects, but I think a more recent one, particularly that I've been involved in, is Adriatic Metals, and I believe Paul Cronin is actually at this conference, who's the CEO of Adriatic Metals. For that particular project, we as EBRD took early equity before they actually started developing the mine itself. And we were able to do that because Adriatic had really started thinking seriously about ESG factors on their project. They had already retained a number of experts to help them develop an environmental and social scoping report to sort of flag potential environmental and social impacts and risks and some initial ideas as to how this could be mitigated. And the outcomes of that process really form part of their feasibility studies that they developed for that project. So when we took early equity, and there were some comments earlier about project categorization, at that point we categorized the project as a B, because our use of proceeds was to develop the studies that would support a future mine. Things like exploration, the feasibility study, some early works, sort of thing like that. But we didn't just focus on that. We looked at the future mine project, because if we took equity, we would be exposed to that mining project. And so we got quite a lot of comfort from the work that Adriatic had been doing. And we took equity, and then after that, one of our conditions was that the basic one that our standards had to be met during the life of our investment, but also that at the appropriate time, the company would develop a comprehensive environmental and social impact assessment in line with both local and good international practice. And we worked closely with Adriatic to do that, and also to publish it, to put it into the public domain. And we felt that sort of engagement from a very early stage to the point where you're doing the very heavy lifting on impact assessment, on influencing mine design, was very positive. It wasn't just us and the company, it was sort of a team working on things. And I felt that worked pretty well. And it's an approach that we apply to many sort of exploration, early mining projects to help them with that move to fully embedding ESG into the operations.
Thank you, James. If there are any questions, please feel free to ask. Okay, I think I'd like to thank the participants of the panel. This was very insightful and hopefully a very informative presentation. The good news is, it might sound, from my personal experience, I can say that that every finance requires environmental impact assessment, but it's not like, when you are doing a project, you need to double down. It's typically there will be one group of consultants involved, and each of the international finance will contribute to the terms of reference, and it's not as onerous as it might will seem. It's important. The key message is to start early, so that embed all the requirements that the lenders, investors are looking after when potentially you will be looking to raise funding at LSE. Two, that you're ready early on, and it's a process, as James has highlighted. Once again, thank you very much to everyone, and the recording of the session and the presentation materials will be available online after the 25th of July. Thank you very much.
Thank you all for taking your time and finishing 5 minutes early. So if you haven't got to, I think there was a Robert Manser. You forgot to ask him the questions. I don't know whether he's has any kind of questions or comments you want to add. Artyom?
Hi. Are there any questions? I would add, actually, Arthur, that I thought it was a great panel. The best panel, and I've presented for the last 20 years, the best panel I ever had was Skopje back in 2018. I think this panel was just as good, although my panel was a little prettier, but you know. Great, no questions. Thank you.
Yeah.
I think the panel would be even prettier and better if we had a bit of a gender balance, but okay, I mean.
That's what I was getting at. And we actually, last time we did have one. Look, we just opened up, and I think this has been a great conference. It's still difficult for people to travel. I'm in Skopje. I'm 235 kilometers away. I have a meeting this afternoon. I don't think I'm going to be able to attend the dinner tonight. But I thought you did a great job, and I thought it was a great panel. The 2 points, actually, I will make 2 points. I think ESG and cost escalation are going to be the words besides M&A activity for the next 5 years for this sector. And I think ESG long term, the sanctions being put on Russian companies, they would have come anyways within the next 3 to 5 years because of ESG. Look, again, I don't like to criticize companies, but there was a spill not too long ago by one of the Russian companies that was just a disaster. And you're still seeing, even at the best run companies, you're still seeing deaths in undermined coal. I mean, it's unacceptable. It's unacceptable. And keep in mind, there's 2 things happening here. You're seeing devaluation of the ruble. So if you're the exporter, in any economy, devaluation for an exporter is positive, right? Your prices either stay constant or increase, and your cost base is decreased. And so these guys are printing money, and that should be reflected in their share prices. It's not because of the Russian discount, and people are talking more and more about that. That's the other thing out there. It's a little bit different in the oil and gas sector, but oil and gas you have to be careful about, because an oil company also has refining and marketing, which has, when you see a collapse in the oil price, yeah, the upstream margins decrease, but the downstream margins still remain the same. With a mining company, there's no downstream. You've got a mine and a mill. I don't even know of a mining company that has a smelter on site. I don't think there is. So you don't have that margin cushion. So very interesting. Thank you.
Thank you.
Okay, thank you very much for all your contributions. And while, Robert, actually, while you're here, so you still actually have time to catch up with us and kind of join the gala dinner, which you're kindly co-sponsoring with us tonight. So catch the plane if you can. If you can't, we wish you all the best with your recent transactions. So actually, I believe it's still ongoing, and good luck with that.
Can I make 2 points then? I'm at the Marriott. I told them I'd give them a pitch. So I'm at the Marriott in Skopje, fantastic hotel. Unfortunately, not for sale. And the second point is we're looking for 5-star hotels everywhere in Europe.
Okay, Robert, but what about mining? You are planning to invest in one of the properties in Albania. Okay, here we go. I got you on the spot, so that's why.
Very confidential, but
No comment.
We'll look at anything that's very attractive. It's an interesting time to be buying mining. It's a great time to be selling mining assets. It's an interesting time to be buying, but if you're paying with equity, so you're paying with inflated shares, as long as there's not too much equity cash on the table, it's a great time to be buying and financing out there. I mean, as long as there's no Russian angle to it, everything in Central and South Europe and the Baltics, Balkans, I think is very attractive. I mean, you were here in 2018. There's a gold copper deposit here that's already got financing in place with SocGen, another bank. They can't get the permit for it. Permitting is the biggest issue. You're seeing that also in Greece. And other places, you're seeing it with Rosanna, Montana, which we looked at a long time ago, and 13 million ounces of gold. Processing is a challenge, of course, but on different levels. No, I think it's, again, structured correctly, it's a great time to be buying mines. Structured correctly, it's a great time to be financing mines. 20 years out, get your kids to learn Mandarin.
Thank you, Robert.
Right, okay. Thank you very much to all the panelists online.